Well, thanks for tuning into this conversation of the Alpha Strategist. It's a monthly product that the Motilal Oswal Wealth team comes out with, and the men involved in the product, Ashish, Shanker and Nitin Shanbag, join me right now to talk about this month's issue. And they're calling it walking the talk after calling 2024 as the year of the all-rounder, where you need all the asset classes. I presume, gentlemen, thanks for joining in. I presume that what you're trying to say in this note is that your belief around the year of the all-rounder and the good times continuing have gotten emboldened or gotten verified, if you will, by what the finance minister has done in the union budget. How important is that for the investing implications for the year at large?
Hi Niraj, thanks very much. It's always a pleasure to be on your show and talking to your viewers. So you're right, as you know, we set the tone for the calendar year in January. And clearly our view was that all asset classes are looking fine. And this is a year where we are advising investors not to go overboard on their asset allocation on any single asset class. So if you have a certain asset allocation mix which is working for you, just stick to that. Because whether it's gold, fixed income or equities, all of them look reasonably attractive and balanced as far as their own valuations are concerned. February, the Alpha Strategist note was centered around the budget because that was the big development, the interim budget. Now, it is titled Walking the Talk, and as the name suggests, we believe that the government has basically stuck to the core principle of fiscal consolidation. And this is really, really refreshing because we are going into an election season, and generally there are expectations built before the election budget that there will be freebies, there will be giveaways, there will be incremental allocation to welfare schemes. As opposed to that, this government has really been very clinical about the budget. What they've done is they've given a clear path on fiscal consolidation over the next couple of years. If you recollect, post-COVID, we were comfortable with a slightly higher deficit because you had to do a little more on the welfare side. The economy slowed down, the tax to GDP collections came down. But over the last couple of years, we've had a reasonably good recovery. And now the government has again put the economy on a path of fiscal consolidation. We believe, and the other big thing, Niraj, is that if you look at the quality of expenditure, right, that is improved again. What we are seeing is higher allocation towards capital expenditure, lower budgets to revenue expenditure. So essentially, this government is saying, hey, we are going to keep the budget deficits tight. We are going to spend more on capex, which will spur future growth for the country. This is a big signal, especially to foreign investors, and it's a big signal from a economy point of view, because a better fiscal deficit means better currency stability in the future. As you know, most foreign investors, when they come to India through the direct route or through the capital market route, they like continuity in policy, they like a stable currency, and they like the fact that the government is essentially walking the talk. So we believe it's a good interim budget. Of course, we have to remember that it's an interim budget and there will be another budget post the elections. But the signaling is extremely strong. And they've kept the currency in mind, and they've kept the fact that as a country, we'll continue to require a lot of foreign capital in the future to build out some of the infrastructure that we are trying to build. So it augurs pretty well for fixed income markets because this ensures that there is no crowding out in the debt market from a government point of view. Hopefully, we will see a lot of FDI money coming into fixed income as well as we get included in some of the global bond indices. From an equity standpoint, it gives continuity on the policy front. So all in all, good budget, and we are happy that the government has walked the talk when it comes to the overall measures.
Yeah, Nitin, you are out and out in numbers, man. And forgive me for bracketing you that way, but it just stands out when you talk. So I'm trying to understand. What numbers stood out for you? Now the budget is long digested, right? So everybody's bored of it if we talk about the budget, but I'm sure you have a data point or two which could be so interesting. So Ashish has laid the context beautifully. Now supplement this with maybe a number or two which stood out.
Sure. So talking about fiscal deficit itself, we are talking about 5.8% for this year. coming down to 5.1%, which is rather significant. But the path towards fiscal consolidation then lays down a 4.5% number for FY26, which looks aggressive, but the fact that they did not do much as far as populism was concerned is a big merit, right? Now translate this into borrowing programs and tax collections, right? The tax collections through GST alone have risen rather dramatically over the last couple of years. FY22, the average monthly collections were about 1.2 lakh crores, which have increased to about 1.5 lakh crores in 2023, FY23, and which will close in our, possibly around 1.7 lakh crores by the end of FY24. That's a monthly number, right? So that's rather significant. What this has done is it has allowed the government to borrow less from the market. So last year they were talking about borrowing 15 lakh crores. FY25, they are looking to borrow just about 14 lakh crores. And now couple all of this with whatever Ashish was mentioning in terms of potential inclusion in not just the JP Morgan index, but other global bond indexes as well, because now Bloomberg is also talking about, or rather having a serious conversation about adding the Indian government bonds into their bond index. The 10-year GSEC in India has come off from about 7.4% down to about 7.45 as we speak today. And this is a rather, dramatic, yield drop without actually the RBI doing anything as far as interest rates are concerned. So already investors who invested, as per our advice that we've been giving since October on the 10-year GSEC, they are sitting on a capital gain of 1.5 to 2% in absolute return, in addition to the coupon that they would receive on a year-on-year basis. So we are rather happy that things have kind of played out the way they have, and it still merits, allocation to the long-term GSEC. You would need to calibrate your fixed income allocation, as we've been, advising over the last few months. I think some of the other things that you could do is get into multi-asset solutions. Some of those multi-asset solutions that operate as fixed income alternatives will actually give you 4 indexation benefits if you invest anywhere from now till the end of March and hold them beyond March of 2027, right? So automatically, most of the yield, which today hovers between 7.5 to 8%, will come to you almost tax-free. These are some of the ways that I can articulate in terms of numbers on how you can construct fixed income portfolios at this stage.
Okay, well, thanks for that. And some interesting observations from both Ashish and Nitin on the things. I mean, one is that there is something for both equities and debt for the year at large, which is what was kind of exemplified before the budget speech as well, and after the budget speech more so, and some interesting ideas out there for benefits from an investor's perspective, especially on the debt side, simply because the time period is such that we are on 22nd of February, so it's about 30 or 38 odd days that you have in hand that you can get an indexation benefit for the whole year if you choose to invest currently. So keep an eye out for that. Now, Ashish, the point most misunderstood by a lot of people was the capex number, which as a percentage has gone down, but as an absolute obviously is moved up. Now, there's a lot of conversation around how for 11 months of the year, because 1 month might be gone in Achar Sanhita, this is a good enough number. I would love to draw your attention or tell us how you think about it from an investing angle, this whole capex plan, because I saw this chart on your screen wherein you've mapped out obviously the central government capex as a percentage of GDP, but also the capital allocation to the different sectors. I would love to know if you've done some work around what themes benefit out of doing capex in the way the government is doing.
Right. To just share some perspective, Niraj, if you look at the budget allocations, the growth in capex over last year is about 16%. So this is the second consecutive year where capital expenditure is growing at double digit for the budget allocations, whereas revenue expenditure is a low single digit, right? Now, the other framework to look at, and this is a framework we look at, from an investment point of view regularly, is which consumer is going to spend over the next 2 to 3 years, right? Government is a consumer, there are private companies who are consumers, and there is households who are consumers. today the two consumers who are spending or who have actually laid down the budget to spend a lot, one is government. Okay, now let's look at government like you mentioned. Government is basically going to spend on defense, they are going to spend on railways, and they're going to spend on overall infra, whether it is roads, ports. So a lot of the companies which are government facing, B2G, you can see this in their order books, right? Order books are building up as a percentage of the sales. So we are essentially bullish on themes related to defense, related to railways, and related to overall infra spends from the government point of view. However, I would also like to mention at this point that the other consumer who's spending from a capex point of view is the Indian household. The main expenditure from a capex point of view for Indian household is real estate. And that is evidenced from the bookings that you see real estate developers getting. I mean, if you see the quarterly numbers, which we are through, right, real estate companies are on a tear. I mean, any project that they launch is getting sold out like hotcakes, especially in the mid to high end segment, right? Which basically tells you that there is a wealth effect. And from an affordability point of view, as well as from a lending point of view, things are very, very attractive for the consumer who's buying real estate. So these are two areas which are doing extremely well. Now it is a matter of time where companies will also start doing capex because as we speak, the capacity utilization number is I think close to 74-75% if I'm not mistaken. So at the most, optimum capex, optimum utilization, which we consider closer to 80%, is about 6 months to 9 months away. So we are already seeing a lot of companies, at least when we talk to them in their management calls, etc., laying out plans for future capex. So I think by the end of this calendar year, you'll have all cylinders firing. I mean, from a capital expenditure point of view. So anything related to the investment economy is looking pretty good. Just a mention on the earnings season because that's another topical. That's another topic of discussion today. We are behind the quarterly earnings season. At the end of this, the broad numbers look pretty good. I mean, you've seen a 17% earnings growth YOY. We will end up this financial year at 20% YOY growth. This will be the fourth year of double-digit earnings growth for companies at Nifty as well as in our coverage universe. And you're looking at 14% next year. So even from a fundamental corporate point of view, things are looking fine. And maybe Nitin can expand on it.
Yeah, I mean, think about it. This year, you would end at somewhere around 6.5 lakh crores as far as total profitability of the Nifty 50 companies are concerned, which is expected to grow to about 10 lakh crores in another couple of years. And the key sectors which are likely to drive it, as Ashish mentioned, are some of these old economy sectors, auto, and of course, BFSI as well. BFSI has done well. I think the difference now is between the private and some of the large PSU companies that are there. But I think the entire pack is running, and in many ways, this reminds us of the period between 2003 to 2007. Right, the fundamentals are extremely strong. In fact, the run rate in terms of earnings growth is rivaling the 2003 to 2007, and in some cases even exceeding that number. And that gives a lot of cushion to valuation. So while a lot of chatter is on the fact that markets are on a tear or valuations in some pockets looks fairly exorbitant, but I think the earnings growth is quite up there in terms of providing the valuation cushion.
Gentlemen, a question on equity side, because I noticed this interesting statistic that you put out, right? That since the lows of calendar year 23, the kind of gains that have happened at the broader end of the spectrum have far outstripped. And we know this, but just when it comes in form of numbers, it kind of makes you stand up and take notice. So part one is the difference in returns that's happened. In part two, I'm borrowing from the previous answer that both of you gave, that in some cases, these might be justified because earnings growth will make up for it. So now I'm just trying to narrow this down a bit. We haven't done this before, but if I were to narrow it down to the small cap universe or the mid and small cap universe and ask you that based on your study, where is it wherein the gains have far outstripped the category or the Nifty as the case may be, but where by virtue of earnings growth, the numbers could be justified?
Sure. So maybe I'll just take on that question. Now, in the last year, as you mentioned, the mid and small caps have returned in terms of the total market cap. So we are talking about mid caps, which is the 101st to the 250th company, and the 251st to the 500th company. If you look at their cumulative market cap, that has expanded in the last year or so between 40% to close to 65 odd percent, right? Which in most circumstances looks fairly exorbitant. But now let's put this in context of the earnings that these categories have seen, especially over the last 2 to 3 years. The mid cap earnings have grown in the vicinity of 25 to 30%, and the small cap companies have grown in the vicinity of 35 to 40%. And this is merely at an index level, right? So some of the underlying companies have obviously grown at a much faster pace. And if you remember, Niraj, even last time we had discussed this, that there is actually no point merely looking at the headline index. You have to focus on quality companies, because not all those companies are extremely high up there in terms of ROE or ROCE profiles. But when we narrow it down to quality, whether it is within the PSU sector or whether it's private or any of these other sectors, in a diversified basket, if you're getting good quality companies, they will command a premium, but the earnings growth is providing a great tailwind, right? So we believe that while the markets might have rallied quite a bit even in that segment, and now let me give you one more context in terms of the price to earnings multiple. If you look at the headline earnings, the headline indices for mid cap, the long term 10-year average is about 20 times. Currently, the 1-year forward PE is about 26 to 27 times. If you look at the small cap index, the long term 10-year average of PE is about 16 times. Currently, it's trading at about 21 times, right? So these valuations are relatively higher as compared to the Nifty. The Nifty is at its long term average of about 20 times, right? So hence, there is a lot of articles around the mid and small cap space. We believe that one has to be very bottom up in that segment. If one wants to take any incremental allocation to mid and small caps, it would be preferable to do it in a staggered manner over the next, let's say, 6 to 12 months. Having said that, on the large cap side or even multi cap strategies, we continue to be extremely constructive, and we are asking investors to invest lump sum even at current levels.
Lump sum even at current levels is what is actually also based on the sensitivity analysis or the expensive zone, etc., that you guys have. That's not too negative currently for this kind of investing as well, right, Ashish? Because I was looking at the 3 zones that you typically put out, and we are not currently in a major fragile zone with accidents waiting to happen.
Not at all, because if you look at the temperature gauge, which is what we publish every month, we are close to 114, 115, and this is basically reflective of the Nifty valuations. And remember that we are past the Q3 earnings, and we are actually into the Q4 season, right? So the Q4 earnings will only get updated sometime probably in June of this year. The earnings will get done by April. So actually, if you adjust it for that, my sense is that you will be below 110, because you're looking at 1000 EPS for the Nifty by the end of this financial year. So actually, the Nifty doesn't look really expensive. It looks reasonably valued. And hence, what we are telling investors is that large caps you could go lump sum, and mid and small caps you can do staggered. And just to answer your question on which zone is looking a little rich in terms of valuations, actually, if you look at everything, collectively, the mid cap zone is really a little expensive compared to the small cap or the large cap. But see, as long as earnings, they continue to deliver on earnings, I can tell you that valuations will continue to look this way. Although there will be pockets of exuberance, for some time. I mean, in a bull run, you do get these anomalies, and these anomalies can last for longer than you really.
Stay solvent, I know. Okay, we've last 60 seconds, but just one quick question, Ashish, before we wrap this up. You made this point in your previous notes, 3 years of double-digit returns, possibly a 4th year double-digit return. We were talking to the Citi team earlier, who was saying that even FY25 earnings, according to their coverage universe, have actually gotten an upgrade at the end of Q3. I'm inclined to check with you. in your case, is earnings momentum looking better for FY25 as well after Q3? Quick 60 seconds.
It's looking solid and stronger. Let me put it that way, because the high earnings growth phase, I think, is behind us. Post-COVID, the base was extremely low. A lot of sectors had not done too well for a long period of time. You saw very, very high earnings growth for the last three years. Now you're moderating it to maybe 13, 14, 15% kind of growth. So the high earnings growth is behind us. Now you're looking at slightly moderate earnings growth, but with much stronger visibility, because the economy and the corporates are in a much stronger footing.
Predictability, viewers, and that always demands a premium on the political side and on the earnings side. Walking the talk is the title for this month's Alpha Strategist. Gentlemen, thanks for walking the talk with us on the show as well. Looking forward to talk to you next month.
Thank you very much.
Thank you.
Always a pleasure.
Likewise. And viewers, thanks for tuning in.